All right, everybody. So we're quickly going to just review the markets today and the opportunities, etc. All right. So we had the ES today. It was a number of trades. So the first trade opportunity was right here. Where you had, no, not there, here. So over here, as the market went down, there was buying activity that offered a pullback and then the reversal. But here's the key thing to note. If it attempts to go higher and gets stuffed on that much volume, there's a problem. So this market was positioned to go up here, but someone sold 63,000 contracts right there. That's the biggest print. So it messed it up for longs. If you were long and you got in over here, right here, you're wondering what's going on, and it'll go back to break even, right? Otherwise, this was set up really nice. You had lack of supply, and you had demand come in right here, 2.7, bigger than 28 waves, pulls back, volume is still kind of low, and that's why it rallies. But as it attempts to break these multiple highs, someone came in and sold a very large number of contracts, and the buying could not absorb it. So as a result, the market pulled back. Okay, so no big deal. As it pulled back, I noticed right here the market is picking up. Why? Because it was at a level like this level is the break, right? It pulled back all the way to that area. So it's retesting this demand zone. And as it's retesting this demand zone, I'm watching here the volume comes in and the price rallies just a little bit. Not too much, just a little bit. When it had this volume, it also had green bars. These are the ease of movement bars, but they're not normal bars because they're coming from volume. So right here was another entry opportunity. So, this entry opportunity went all the way back. Where to? And this is really important. It went back to this same supply, someone who sold, whoever sold that 63, that's the same area that it went to. So that area is very strong resistance. That's the overhead volume, which you call distribution resistance. This is distribution resistance, and that's where the market went to. So you have to know this, that, okay, this is not a normal, high, low, high, low. This is distribution resistance. So for the market to take it out, it has to absorb a lot and then break through. It didn't do that. It went up, volume increased here from 4 to 17 to 14 to 33, and it couldn't fall through. It could not absorb this 63. So if you were in long, you had to get out up here. Okay. And this visibility offered you the opportunity to say, oh, you know what, we're at that distribution resistance. I don't know if it's going to take it out. Let me just get out. If the pullbacks are weak, I'll just get back in, probably around this area. So this was the key indicator that last time it went to that area, it got stuffed. This time is going to go to that same area and very likely get stuffed, right? And after that, market went down, down, down. When it went here, this I knew again that they're gonna move because the wave is too strong. .8 times average up volume, and the biggest in 21 waves. This wave is the biggest in 21 waves. No doubt there should be some bounce on the pullback to this demand zone, right? So we see that you have buying activity here and there. So this area where there's a 12 is the first one where you had heavy buying activity. That's where the test went. Not once, but twice. Right? So pull back here, rally. When it rallied, where was the distribution? This is a minor distribution. Right there is the biggest print. So that's not demand. Why? Demand comes at the lows, not at the highs. This is demand because it is at the near the low. This is supply because it's at the high. You have the high volume print, no follow through. Distribution. And these are minor accumulation and distribution that create the the rallies that are tradable. So for example, where is that? Remember, you need to see ease of movement, right? So this that buying activity pop, test, boom, offering you a nice trade, right? Nice pullback, one swing trade. After that, it goes to the same area right here. I already know it's rallying. So when they come back down, what do we notice? High volume, no follow through, volume at the lows. Volume at the lows, bingo. Accumulation. Do we have ease of movement? Because without ease of movement, it could be anything. It could be nothing. Right? So the first thing I know is that it's high volume. Second thing I know is that it's near a prior demand area. This demand area. It's coming back to the demand area. The demand area, rally, pulls back to demand area, high volume, no follow through, reaccumulation. And these are minor reaccumulation. I'm not talking about the phase A, B, C, D, and all of that. All right, I could care less about this. This is evidence, data points. Boom, goes to the demand zone of the rally. This is the rally. This is the demand zone of the rally. Goes to the demand zone of the rally. Volume increases because it's a reaccumulation. It has no follow through. High volume, no follow through, reaccumulation, but you don't know until there's a movement. So that tells you, buy me. And that overhead, it's easier to go up than it is down because they're buying down, so it's easy to go up. Easy movement. Breaks that high with this green bar, and you get the rally. And that's it. This I don't think I can predict that. That's about it. All right. So this demand zone. Why didn't price go all the way down to this demand zone? This pullback, you see this rally? Why didn't this pullback go all the way down here? That's a good question, because there's heavy buying activity here, right? And that's because there's more heavier buying activity higher up. This area has heavier buying activity than this area. How do you know that this area has heavy buying activity? It's because of that chart. And you see the print right there. That's what's going to get tested and retested. Right? So when it comes back down, look at this area. We have that high volume print, that initial accumulation. Boom. Goes right to that area, 21, increases, cannot break through, can't. When you see this, it doesn't mean, oh yeah, let me buy, that's demand. It means that supply has encountered demand. So supply encounters demand, just like up here, demand encounters supply. It can break through, go straight down, especially today. But it doesn't, and instead you have a reversal. That reversal, when it's a strong reversal from that area, it's ease of movement, taking price up. Price goes here. I don't really see if there's high volume activity there. It was right here, heavy demand area, so it didn't go that low. Right here was that heavy supply activity. Already got tested. Anyway, so the opportunities were there. The first one was over here, but it didn't give a big move. Why? Because the supply came in. That supply was here, 63,000 contracts. 63,000 contracts stopped the up move here. Went down, they reaccumulated, flop. Right. These green bars are the ease of movement. Sets up the next rally, which gets, encounters distribution resistance. Down, 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 down. More buying activity. What is this? What is this? This is absorption of this high. That high, market's going into it, up, down, up, down, up, down. Why? It's absorbing. Pumping activity right there. This test of that absorption area, the heavy demand area is now, the absorption area is the demand area. It's like a demand zone. Right, this here is the demand zone. Demand zone is just the accumulation zone. Right, this is demand zone, absorption, test, go. And you can see when you have bars that are going up and down, when you have bars in movement, it's, they're not overlapping. Down, 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 down. The overlapping bars you have to pay attention to. The pumping action here. Up, down, up, down, up. What is that? That means you want to sell, I want to buy. You want to sell, I'm going to buy. You want to sell, I'm going to buy. Eventually, whatever you're selling, I'm buying it up. So you must pay attention to the overlapping bars. This is not random behavior. It has meaning, especially in the support and resistance areas. This whole area is support, and there's pumping action because this is the reaccumulating action. This pumping action against that high, first is the break, second is absorption. We attempt to break, they attempt to sell. We buy, they sell. We buy, they sell. We buy until they can't sell anymore and break through. Same thing. Oh, where was it? Was it here? here. Same pumping action. This is a lot. Up, down, up, down, up, down, up, down. When you go sideways like this, it's not a coincidence. Remember, each bar is buying or selling. So why are they not making progress? Meaning the buyers are they're facing resistance. They're facing selling. Buy, sell, sell, buy, sell, sell, sell. So it's that pumping action. Right here too. Right here against this high, buy, they want to sell it down, we buy. You want to sell it down, we buy. You want to sell it, we'll still buy. Against this resistance area. Again, see that pumping action? It's not random, folks. This has meaning. Price is going down, right? It's going into that same breakout or absorption area. Sell, there's a buyer there. They try to buy, sell, and break. And then it gets tested. But those sellers are still there, and they won't let it pass. That's for another one right here. And when it goes, retest, pops a little bit. All right, the other one I wanted to show was the NASDAQ, which I think had some, sometimes, you know, NQ is clearer than the ES. So, take a look. In this case, it's very clear. I mean, price goes down. You can see this area. The accumulation is more clearer on the NQ than it is on the ES. Why? Because basically got a signal there. So over here, you have this block. It's not random. It goes down. All this starts going sideways, same pumping action, up, down, up, down, up, down, sideways base. There's your ease of movement right here. The volume comes in and makes price progress. And that's part of this sign of strength or change of behavior. And it's much clearer here because this is, you have the biggest volume in 38 up waves. 38 up waves. Biggest volume. Biggest wave in terms of distance in 22 waves. Biggest wave in 22 waves with the biggest volume in 38 up waves. I mean, no, this is not rocket science, right? And yeah, I mean, there's nothing really more to it. It's done. Buyers are in control. And then pull back. Where did it pull back? Look at that. To test the minor creep, which is right here, this minor creep, where the green bar was that broke, right? Test it, rally. Reaccumulate, where? Right here. Can you prove that it's reaccumulation? Evidence? Ease of movement. There's the potential Reaccumulation, well, all we could say is supply encountered demand. As it encountered demand, there was ease of movement to the upside. Bang. That initiated the rally. So supply encountered demand, demand overcame supply as proven by or confirmed by the ease of movement. Therefore, you have a rally. Here the market pulls back. As it's pulling back, right, we're watching. Buyers come back in. High volume, no follow through. Is there ease of movement? This one doesn't really have ease of movement, right? But you just have you have a bar, but it's not. I mean, it doesn't get picked up, but you can tell that it's a strong bar. Right here, reaccumulation. $32 and the 22. And pulling back, going sideways, finally, right here, it's being detected that the market is reaccumulating. And you have ease of movement. Ease of movement is big bar. Yeah, it's a big bar, but I prefer the big bar to be after some form of accumulation or distribution, as then the big bar becomes ease of movement, confirming this accumulation, any of the accumulations or distributions. Right, so there you go. That's the chart reading. What is this up here? Price goes up. The minor distribution goes down. All right, and the other thing to note is just because the volume is high doesn't mean it's accumulation or distribution. Could be anything, right? So you have to use your judgment. You know, I know that price goes up, and then immediately encounters this. This is supply, right? Because buy low, sell high, so it's going to be some pullback. And know that as price goes down, it's going to encounter the supply is going to encounter demand. That's it. It doesn't mean everything that's highlighted is supply or demand, you know. And it definitely doesn't mean there's a reversal. There's the concept of trade location that must be understood, right? Because if you have, for example, this up here, that's different than this down here. This up here is not in good trade location. Who knows what this is? Maybe it's I have no idea. Right? In fact, it's breaking. This is breakdown volume. This is breaking this low. This low. This is breakdown volume. This is not demand. This is breaking the column lows. So this is, what is it called? Breakout. It could either be breakout, it could be absorption. So it's breakout going lower, lower, lower. You know, why? Because you have a series of lows. This is the breakdown volume, taking price lower, lower, lower than here. This right here is the breakout volume. Right here, breakout volume. In a base, this is the accumulation volume. The highs, I call it distribution, but it could also be called a minor climax. You know, and it could be nothing at all. You need to confirm with trade location, levels, and ease of movement, and just look at the wave bar chart right here to put the picture together. And this is the issue with like mechanical signals. They don't consider all of these other factors. That's why most mechanical signals are off, because they don't consider. The reason why, I'll tell you now, the reason why mechanical signals, using whatever logic buying selling logic, any mechanical signal that uses buying and selling logic, if it doesn't use trade location logic as well, it's not going to work. Oh, any mechanical signal, any mechanical indicator that doesn't use trade location logic will have a high degree of randomness. Anyone. And all of the mechanical indicators that are on the market, I'd say 95 out of 100 do not consider trade location. The overwhelming majority, I haven't seen any of them that consider trade location. The closest they'll come to what they believe is trade location is overbought and oversold, which is not trade location, it's a mathematical calculation. It's not based off of an actual data point in the market. So there you go. Anyway, I'm done. Have a good day. Again, if you want to learn the wave chart and all that, you can easily go on Big Mike's. And there's I've seen like 1 or 2 webinars on YouTube that teaches where David Weiss teaches all of this. So pay close attention to that webinar. That's really important. And then this you don't really need. You can use any type of chart that's volume price. But this comes from the Wyckoff course and the tape reading part of the Wyckoff course. That's not in the swing trading part. Right? It's the other part. This is, and then I've just modified it so I can quantify things a little bit better. But it's the adaptation of that particular type of chart. That's all I got. Have a good day. Bye.